highest sales in 1 year that we've ever recorded. The peak of the ethanol boom, and then 2021. So now I'll show you some actual sales data. And again, this is farm ground. This is tracts of land that are at least 80 acres in size, at least 85% tillable. And we like to use, price per CSR point, right? Dollar per CSR point. It provides the most accurate reflection of value because you have price and quality, apples to apples. So here is your state of Iowa dollar per CSR point. And again, you see 2021. Significantly different than the past 6 years. The 6 years we had that stability trend, plus or minus $2, $3, around that $110 a CSR point. And again, this is the entire year state of Iowa average. So now I've broken it down quarter by quarter. And again, you can see, when did the breakout from 110 really start? The answer was the fourth quarter of 2020 at 119. Then the first quarter of 2021, you saw 124. And then all of a sudden, in the last 3 quarters, that's when the acceleration started. 142, 147, and we ended with $164 average dollar per CSR point. That's the highest single dollar per CSR point we've ever recorded. So there it is. Which one? Yeah, that's the number of sales. Yep, and then on the far right, it's the CSR. So again, you can see the number of sales. What happened in that 164? We had 362 sales. So again, as more and more land came on the market, that supply didn't drive it down. The market absorbed that, and I'll talk about that in a little bit. And again, here is our whole loan portfolio. So this is all of the real estate loans we've made over the last 7 years. There's over $17 billion, that's a B, in transactions. And again, the top portion is the average borrower profile, their financial position. And the bottom is the loan condition. So again, who's buying the land? Well, these are people with cash, liquidity, working capital, a current ratio of over 2.5 to 1. These are people that are not leveraged, an owner equity in the upper 60s. And again, they have strong repayment ability, a debt coverage ratio of almost 2 to 1. And then when you look at loan to collateral value under loan conditions, again, you look across there, it's really at or below 50% all 7 years. So again, this discipline has paid off for agriculture all these years, and it'll pay off in the months ahead. And that discipline is all about who's buying the farm ground. Well, it's being bought from a position of financial strength. Financial strength. This is not a high leverage game. And again, significant equity, both cash and collateral, are going into these purchases. Again, this discipline has paid off for agriculture and will continue to pay off in the months and years ahead. You all in the back can come down and grab chairs if you want. Come on, Jamie. So don't be shy. So I want to give you some land value perspectives. Again, for the first time since 2014, it's been 6 years, we've seen a movement in our land values, and what a movement it was. Again, I kind of make the statement, we have a 1-year trend. We have the biggest 1-year trend in our benchmark history. We have the highest dollar per CSR point that fourth quarter that we've ever seen. And I think it's common sense as we look forward to think, boy, that's going to level off a little bit. Do I think that trend is going to continue through 2022? I don't know, but not likely, right? Because some of the tailwinds are not as strong going forward, and we'll talk about some of those. But again, why did this all happen? The fact is the stars all aligned, right? The stars all aligned. We had interest rates driven clear to the floor by the pandemic. We had significantly higher grain commodity prices. On the fire with all the influx of the government money. But I think equally true, maybe there was a Lack of alternatives. Where else will I put my money? Do I want to invest in commercial real estate in the new Zoom economy? Do I want to go and get a bank CD that I can get 1% or less? And do I want to put money in the stock market at all-time highs? So I think both of those things, lack of alternatives and just all the stars aligned, and guess what? We created the perfect storm or the perfect environment, however you want to look at that. And then we answered the question, what's going to ever happen if we get a significant supply of land come to market? And the answer is the market absorbed every single acre, because willing and able buyers are not hard to find here in Iowa. And you really have to understand one issue, just one issue. 80% plus of our ground here in the state of Iowa is owned free and clear. And the fact is we have plenty of capital, plenty of collateral, plenty of dry powder. So again, we were able to absorb that supply. But I think here's the real question as we look at the market today is, how will the market continue to reconcile the long-term nature of the land asset with some of the short-term, right, positive drivers? And that's a balance. How long will these margins last? How long will this all last? I think that's the key going forward. Again, this is why I said commonsensically, we can't see this trend just continuing forever. It doesn't make economic sense. But at the end of the day, I always remind people, farm ground values will always be determined by the market, buyers and sellers of owned acres. Farm ground values are not driven by university professors, economists, lenders, podcasters. We report on the data. And at the end of the day, it's buyers and sellers of owned acres. It's the market that will determine the values. So I'm going to switch gears here a little bit and talk about interest rates. And we had another pretty dynamic interest rate environment in 2021 as we look forward. Here's your interest rate chart. This is where we are today. You can see at the very bottom, right there in the middle, that's your variable rates, prime, right? 3.25. That's the all-time low. That's as low as we go. And I made this 10-year treasury about 10 days ago. It's already accelerated through 150 and 160 to 170. So again, the Federal Reserve bond taper is happening, but that's where we are today. So what's going to drive interest rates as we look forward? The first three factors are the three factors that really drives monetary policy, Federal Reserve action: inflation, unemployment, consumer spending, consumer confidence. The fact is, agriculture, we don't drive monetary policy at all. We're just impacted by it. But again, in today's world, we have other factors, the supply chain disruptions, which is probably fueling inflation to some degree. Politics, we've poured trillions of dollars into this. Are we going to pour trillions more in the months ahead? We don't know. And of course, the US federal debt at all-time highs. So monetary policy is not quite as simple today as it's been in the past. But again, I always tell you, remember, it's the top three. It's the top three that typically drive monetary policy. So what is the Federal Reserve going to do? It's really going to do two things. It's going to increase short-term or variable rates in what I would call modest 25 basis point increments. It's likely to start doing that in March. It'll probably do it 3 or 4 times in 2022. So again, what does that mean? 3 or 4 times, that means we're going to be at 4%, maybe 4.25. So you can kind of look at that chart and kind of go, okay, that's where we're going to be, right? And then it's going to taper its bond buying activity. In other words, it's going to take demand or liquidity out of the market. It's already doing that. And again, that's going to cause long-term rates typically to rise. We've already seen that in our 10-year Treasury benchmark. And so at the end of the day, I want to make this comment. Rising short-term rates, rising long-term rates don't mean high interest rates. They don't mean high because we're coming off all-time lows. So if you rise off of those all-time lows, again, remember that 4.25, we're probably still in the low end of normal somewhat as we think about 2022. So when you hear the term rising interest rates, don't start immediately thinking high interest rates. That's probably not the correct perspective. And here's kind of a chart that shows that perspective. This is the 10-year treasuries over the last 20 years. So you can see where we are today. And again, those red circles, that first one, those were the terrorist attack in 9/11. And the middle one was our financial crisis in 08 and 09, and then the pandemic. So again, as these interest rates start to rise, this is why I make the comment, we're probably still going to be at the low end of normal perspective in this environment. So here is our forecast, and again, remember what a forecast is. It's not a promise. It's not a guarantee. It's our best thinking with what we know today. And again, we're going to have a rising short and long-term interest rate environment. Again, short-term rates. You know, in the past, the Federal Reserve at times has raised it 50, 75, 100, but we think they're going to be modest 25 basis point increases, 3 or 4. And again, we already talked about the tapering activity. We believe 10-year treasuries will rise above 2%. They're starting to go there even as we speak. But again, I said the comment, we're going to remain on the low end of normal, and we think that interest rates, frankly, will still be relatively accommodative for agriculture in 2022. So while we're on this topic of interest rates, I want to talk on the concept of refinance. And I debated on whether to do this because in some ways that window's closing, right? We've done a lot of that activity over the last couple of years. But I wanted to touch on this because the principles that we've dealt with are timeless. They're going to matter 1 year, 10 years, 20 years from now, and I want us to understand some of these. So again, why would you ever refinance or restructure your land debt? Well, the first and the obvious one is because I want to lower my payments. And what does that do? Well, it helps my cash flow, right? It actually makes my operation more competitive because it lowers my costs. It lowers my break-evens. But I think the one that we kind of forget is it really helps me retain working capital, liquidity, my balance sheet risk-bearing ability. That's why we refinance debt. And then I want to make another point with some examples. I've got 3 examples. So here's the first one. In this example, we've lowered the interest rate by 1% from 5 to 4. Again, you can see the annual savings there, $3,800. Well, that's real money. That adds up over time. So the second example is where we've kept the interest rate the same, but we've extended the term from 20 to 30 years. And right away you go, aha, wow, that savings is double what the interest rate was. And that's the point that I want to make. And that's a point that a lot of people don't understand. Typically it's the term or the amortization of your debt that has the single biggest impact on the payment, the cash flow relief, and a restructure. And of course, the third example is when we've done both. And of course, that was the advice we've been giving for the last 2 or 3 years is do both. Because again, that way it maximizes your cash flow relief, maximizes lowering your costs, lowering your break-evens, making you competitive. So even today, when people are going to buy a piece of ground, they say, well, Jim, how long should I ask for in the real estate loan? How long of an amortization should I get? And I'll ask you this question. Do you know what the price of corn is going to be in 2 years? Or 3? Or 5? Kirk? The answer is no. Neither do I. Right? Neither do I. That's the whole point. So the whole point is take as long of an amortization as you can get. Take all the flexibility that you can get. Because when times get tough, you might need it. But when times are good, understand what you've done and pay that debt ahead. It's a little bit like having your cake and eat it too. I can always prepay that debt. But again, take all the flexibility you can get. That's our advice as we think about financing land. So now I'll switch gears again and get into grain production agriculture. And because we're in Iowa, I'm going to talk about corn and soybeans. I'm going to talk about some of the demand and supply drivers for corn and soybeans. So here is your December 2021 WASDE U.S. corn balance sheet. Probably a lot of you have seen this. There's lots of numbers on here, right? It can get confusing. So here's what I do. I break it down into supply and demand and ending stocks, period. Because this way you can really tell the story. And when you look at the top line supply, the supply hasn't really changed, right? This isn't a supply issue. This is a demand-driven market, especially in 2021. And again, you can see what that's doing to our corn pile. We have a much smaller corn pile today. We used to have over 2.2 billion bushels. Today we have less than 1.5 billion. So our ending stocks are down. So again, the question then is, wow, well, where did that demand come from? And the answer is China. China, big time. Right? So that red line's 2021. The blue line is the previous year, and the green line's the 5-year average. So you can say, wow, that was different in 2021 for corn. And here's another demand chart. This is your ethanol demand. Again, as we look forward, we think ethanol will kind of revive itself as we increase fuel consumption. You can see that line. So again, as we think forward in 2022 and 2023, ethanol will get back to that, 5.5 billion bushel kind of range. And then here's kind of the supply story. Those orange bars, those are ending stocks. Again, you can see where the ending stocks were in the ethanol boom, right? Well below 10% back there. Okay, that's what happened to the price then. And then you can compare that to where we are today. Not quite that low, but something similar. We've certainly chewed through that corn pile when we had ending stocks to use ratios of 14, 15%. Again, we have a smaller corn pile. And again, here's that same information just on a graph, just the dots. Again, you can see that red dot, that's where we are. Not quite where we were in those ethanol boom days, but certainly not where we were during that extended down cycle. So that's where we are, right there. And then the last chart I have, this is a supply chart, right? This is planting intentions. So think supply. And the first thing you'll notice is, wow, that's not spiking up a whole lot. A lot of that is probably because of fertilizer prices, right? But again, as you think forward then, this more maybe balanced planting intentions, maybe for corn and soybeans, that might be supportive of both commodity groups because you didn't see the spike that we had back in the ethanol days where we were trying to drive well above 95 million acres. So planting intentions. So I'll switch to soybeans. Again, here's your December 2021 WASDE report, right? Lots of numbers on there. Guess what I did? Bang, here it is. Again, same story here. When you look at the top line supply, it really hasn't changed a lot. This is a demand-driven story, especially in 2021. And then again, you can see what it's done to our soybean pile. Now, I will also say a couple of years ago, we had the all-time high supplies. So we're really back to more of a normal. That's not low, that's normal in terms of soybeans. But again, where did the demand drivers come from? Ta-da, China. This is not quite as stark as the corn chart, but again, the previous year was the blue line, the 5-year average. So again, China is a demand driver story for soybeans, just like it is for corn. And then again, here's a chart that shows exports. So we export over 2 billion bushels. It's really important for soybeans, more than corn. And then you can see stocks to use, how much are exports of our use. Well, it's close to 50%. So again, you have to keep in mind that export demand is really important, especially on the soybean side, as you think through these dynamics. And here's that same supply, right, that I showed in corn with the orange bars. Here's the green ones. And what I said was, remember I said soybean stocks, our soybean pilots, close to normal. You know, you can look back at where it was, and then we had that unusual historic spike, and we've come off of it. So really our soybean pile today is, I would call it, in the normal range, in the normal range. And again, there's the dots, right? You can see that historic spike where we went over 20%, but that red dot, we're kind of back in the normal range. And then, of course, here's the soybean planting intentions. You actually see this going up a little bit more, right? Because, again, I would say maybe fertilizer prices, maybe I should plant some more soybeans. I've got profit opportunities in soybeans. You know, I don't know how much dollars I want to put in an acre of corn. I would also say you would have to think about this too, because this feels like it's potentially going to yield a different supply by the time we get to the end of 2022 for soybeans. And remembering that we're still in the normal range for soybeans, we're not low. So those are the planting dynamics of both corn and soybeans today as we think about them in Iowa. So here is our outlook for grain production agriculture. Again, 2022 is shaping up to be another profitable year. Our prices are good, but our one caution is get ready for the margin squeeze, right? Get ready for the margin squeeze because everything's more costly. And again, fertilizer's the obvious one, but fuel, seed, cash rent, machinery, equipment, I mean, everything. So it really means that risk management and marketing decisions are going to continue to be really important, and expect volatility. And I don't mean that in a negative way. Volatility means opportunity, right? Because, you know, with our ending stocks on the corn side, the soybean, if we have tough planting conditions, weather in South America, export announcements, we can go kind of on and on. Growing season pressure. Again, those are where that volatility will show itself. That's where pricing opportunities are going to come, but you're going to have to be ready for them. You're going to have to be ready for them. So again, 2022 looks like another profitable year in grain production agriculture. So now I'm going to end with the section I call food for thought. Again, this is just some perspective, some insight from Farm Credit Services of America. You know, we're the largest ag lender in the state of Iowa. We're the largest ag lender in the upper Midwest. We're technically the largest ag lender in the United States, production ag lender. We serve more than 60,000 customers in our 4.5 states. And so we have a very, very unique view into agriculture. So the first comment I'll make is remember the lessons that we've learned. Remember the lessons that we've learned. We've seen this economic boom cycle before. Higher commodity prices, wider profit margins, escalating land values, right? It was the ethanol boom. And we thought that party would never end. And then it did. And this party's going to end too. And I think the whole point is what knowledge, what insights, what realities can we take from the last economic upcycle that we can apply to today, right? The months ahead. So here's the first lesson. Your cost structure matters. In fact, I'd say your cost structure always matters. You know, sometimes during significant upcycles, it seems like there's almost nothing we can't afford and still make it work. But we've learned time and again in agriculture that high leverage, high costs, high break-evens don't work in the long run. So it's really about being thoughtful about capital expenditures, thoughtful about expansion. What will this do to my costs? You know, a couple simple examples. If I pay cash for a piece of machinery, well, that doesn't impact my cost structure at all. It will impact my working capital, but not my cost structure. If I'm going to meet with my accountant and he tells me to buy 2 or 3 pieces of machinery because we got to get this tax liability down, And now suddenly I have payments for 3 and 5 and 7 years on 2 or 3 or 4 pieces. That is going to impact my cost structure. So again, it's about being thoughtful about what we do in these times. I always tell people, remember, the goal of every grain producer is to have a high revenue, low cost operation. High revenue, low cost. Here's another lesson, right? Working capital is balance sheet risk management. We've done a really, really good job over the last 2 or 3 years of rebuilding and restoring our working capital. Again, here's our simple advice. Let's do a good job of retaining it. Because working capital, we all know, cash is king, right? Your working capital is always your first risk shock absorber. And at the end of the day, if you have working capital as a producer, what that really means is you have flexibility. Because you can margin your own borrowings, right? If you don't have liquidity, if you don't have working capital, guess what? Your lender is going to ask you to replace liquidity with equity or additional collateral. And I've said this for a long, long time. It's not just agriculture, it's any business. It's hard. It's really hard to run a business without working capital. Here's another lesson that we've learned. Your holistic financial position is what matters and should drive your decision making. We've seen a lot of farmers think about their operation farm by farm by farm, or piece of equipment by piece of equipment by piece of equipment. And that thinking is actually wrong, and it can really lead to some poor decision making. But as you think about your operation, it has to be land costs per acre on all my acres, right? Machinery, equipment costs per acre on all my acres. Working capital on all of my acres. And again, I'll make a comment. How much working capital do we advise grain producers to have? Somewhere in the $150 to $200 range. That's probably your minimum. When you get below that, your risk-bearing ability really goes down. So in many operations, they've accumulated significantly more than that. They have a good cushion today. But again, remember, it's your holistic position that should drive your decision making. Here's the next lesson that we learned. Understand your financial position after the capital expenditures, after the expansion. This is kind of that begin with the end in mind situation, right? You have to do the math here. You have to do the projections. Again, what will this decision look like after it's complete? Again, examples. If I buy a piece of machinery and I pay cash for it, that didn't impact my cost structure, but now I got to look at my working capital. Do I still have adequate working capital for my acres? And if the answer is yes, that was a good decision. If the answer is I bought 2 or 3 pieces of equipment and now I have almost no working capital, that probably wasn't a good decision. What are you going to look like afterwards? You probably should have financed some of that, retained that working capital. Or if you're going to buy a piece of land, how much of a down payment do I need? Am I going to use up all my working capital, all my liquidity just for that down payment? And then I'm stuck with no liquidity again. Or am I going to finance a high level? And boy, what's that annual payment going to do? And what's that going to do to my land costs? Remember, it's always the after state that we live with for years to come, right? The after state. Here's the grand lesson of the ethanol boom, right? As we look backwards, high margins are not permanent. They tend to last for short periods of time. In grain production, agriculture, our margins always tend to normalize. And the fact is, when we have a bigger revenue pie, everybody wants a piece of that, don't they? So again, that's clearly the lesson we learned looking backwards. The point is, it's equally true today and as we look forward. So again, as we are in this up cycle again, what's the lesson? What's the lesson that we know is true? It's this. Boy, those high margins are not going to be permanent. They're going to last for short periods of time. Our margins are going to normalize. That's why all the lessons I just talked about are important. And then the last slide that I have. The business of agriculture will continue to be the dividing line. So over the past few years, I've talked about this concept, and I'm going to talk about it again. People have asked us, Jim, what do you see out of 60,000 producers? Is there one issue that really seems to be that dividing line between those who continue to thrive and those who struggle? And the answer is yes. We see it time after time after time after time. But before I tell you what it is, I'm going to tell you what it's not. That dividing line is not the color of your machinery and equipment. Red, green, yellow, blue. It's not the seed that you plant. It's not the chemical and fertilizer you apply. Honestly, it's not even production. And don't get me wrong, production is really important in agriculture, but we see people who produce big bushels who don't produce profitability. Because here in Iowa and the upper Midwest, the fact is we're already world-class producers, so excellent production is kind of table stakes. It's more of an equalizer versus a differentiator. But what we see in our portfolio and what we've seen over the past numbers of years is the dividing line between those who really thrive and those who struggle. It's all about how they manage their operation from a business, financial, marketing perspective, period. Time and time and time again. So those producers who are increasing their business, their financial, their marketing acumen, they're being rewarded. And they're continuing to separate themselves. And what they do is fairly simple. They spend as much time in their office as they do their shop and their field, and they spend as much time running their business as they do running the tractor and the combine. That's it. So again, we believe the business of agriculture will continue to be the dividing line as we move forward, again, in this economic area. So again, as we stand here today at the very beginning of 2022, grain production agriculture has done a very, very good job of getting in a healthy financial position. Restored that working capital, deleveraged, right? We're in a healthy financial position. And what we are saying is, let's remember the lessons we learned. Let's remember the lessons we learned from the last economic boom, because they will serve us well in the months and even years ahead. And we've gotten ourselves in a healthy position, so let's do everything we can to stay that way. Thank you very much. I'll be around for questions or what have you afterward. So.
Great presentation, Jim. I have two questions.
Yes.
One is about, how do you think about soil health? I mean, it's not on the balance sheet any place.
Yeah.
Easily we can find, but we know it matters.
Yeah. So his question is, how do bankers think about soil health? That's hard for lenders.
Yeah.
So soil health usually reveals itself in production, bushels, yields, how do they manage their farm. So eventually, from a lender perspective, I can see it in revenue versus their expenses. So at this point, even in the appraisal area, again, we don't do soil health yet. It's about market sales, like-kind sales. So soil health hasn't really made its way into the appraisal arena a lot. Again, when you say soil health, soil quality, that's different, right? We know what soil quality is. Soil health is harder to describe and monetize. Okay, yep.
The other question I have is generally diversification of what a grower might want to do. And if you get out of the corn and bean matrix, and now you start talking about other things, small grains, or whatever it is, how do you think about that as a lender, somebody who wants to diversify?
Yeah, so again, the question is, what happens when somebody comes and says, hey, I want to grow an alternative crop, I've never done this before, blah, blah, blah. Again, we always tell them certain things, right? Walk before you run. What's your business plan? Do you have adequate working capital if this doesn't go as well to cover this loss? Make sure it's well thought out. But I think the biggest thing is, walk before you run. Start small, prove out what you want to do before you dive head first into the deep end, and then you realize the water wasn't as deep as you thought. Yeah. Yep.
You talk about rental rates, what you saw. Do you flex or
Yeah, so
kind of increase or lower again?
So rental rates, we're just starting to discover that. We usually keep those somewhat private. As you know, everybody wants that. But one of your questions was, what about flex leases? We've always been a proponent of flex leases. In fact, I told people at the bottom of the cycle, I said, this is the time to enter into a flex lease because your landowner will be more willing than at the top of a cycle. But again, we always feel that ultimately farmers and landowners have to work together. That the more you can create a trusting relationship, kind of a win-win relationship, we're in this together, that's good for both parties. And so we've always believed that a flex lease is kind of the fairest way to share the tougher times and to share the good times. Because if you're going to try to negotiate every year, you're always in what? A win-lose negotiation. And that's tough to build a relationship over the long run. So I do think flex leases have a place in agriculture and a place with relationships between landowners and farmers.
You got an example of a flex lease?
There's lots of different kinds. Yeah, there's usually a base amount, and then, you know, because any landowner is going to want a base return, and then it's kind of a sharing of revenue and bushels after that. So this is stump the lender.
It's really fun to talk and read about these high land prices, but other than the seller and the auctioneer, who's the benefits?
Yeah, we were talking about that earlier, weren't we? We said, so his question was, okay, it's really fun to talk about these land prices, but other than the seller and maybe the auctioneer, who benefits? And I think that's a perfect point. If you're a farmer, I've never had a farmer tell me yet, Jim, I want to pay more for my acres, right? But unfortunately, if you're a farmer too, you have to enter the market. So you're right, escalating land values are not necessarily great for farmers because it limits how much you can expand and buy. I've only got so much working capital and dry powder. I can only take on so much debt. It's much better for a seller. And of course, I heard somebody say, well, boy, they're going to have to pay a lot more taxes. Not too worried about that, right? Because taxes is in direct relationship to the profit that you just made. So the more capital gains you might have to pay, it's only in relationship to the profit you just incurred. So
It does give your collateral a lot more value.
yes, those people who already own land and have seen their collateral values, you have more borrowing power. So you're right, in the long run, if I can stay in this game and my land values keep going up, it does give me more borrowing power, right? But I'm talking about the initial investment in the land. Yeah, high land prices are tough for farmers to swallow, but they're still the largest buyers. Yep. Farmers tend to have really patient capital, right? That's the one thing I've talked about that in the past. They tend to have very patient capital because they look at land as a legacy asset. This isn't a 3 or 5 year investment that I hope to make a big return. So this is a generational asset. And so that patient capital, that's why you see still that our farmers tend to be the largest buyers because they look at capital allocation differently than just a raw investor that I'm only returned on my return on investment, and in typically a shorter period of time.
So with your quote there, your dividing line, in the conversations you have with growers, do you typically find the ones that are following business principles, they separate their land ownership from their farm operating business in the way they look at it? Being a real estate owner is significantly different than being a farmer.
Yeah, so his question was, when we see people doing a good job of this, do they separate their, I call it operating entity from their land holding entity? And the answer is sometimes. They think of that differently. I still think they run that business holistically. So we have some operators that own very little land. And so they're what we would call a large lease operation. And so again, because they don't have a fixed asset to fall back on, that means that operation needs even probably more working capital than normal because that's their only risk-bearing ability. And again, those operations that have a land base or a significant land base, again, the whole point there is they look at that land cost per acre holistically. If I own free and clear 1,000 acres, I can pay a little more in cash rent over here and still make the holistic picture work. But again, I have to make sure that I'm not over leveraging those land holdings, because you've heard the term betting the farm. Yeah, that's what you're doing in the end. So it's not one or the other. It's about still looking at all sorts of different business models, and there's a lot of them in agriculture, right, Adam? It's about making your particular business model work, again, from a business financial marketing perspective.
Jim, as dependent as we are on China for our markets, do you have any concerns about the stability and viability of China over there? And I'm thinking in terms of the population. We all know back in the 80s and 90s they were killing girls because everybody wanted a boy. And I mean, the demographics, if you look at some charts, don't look very good.
Yeah, so his question was, do we have concerns about China? That's the loaded question, right? How am I supposed to answer that? I think what we do is we show the charts and we show how important China is. And I think it's really hard to determine where will China be in the import, our exports markets year after year after year. We believe a lot of that corn activity was because of the African swine fever and the rebuilding of their swine herd. And will that really continue at that pace? That's the question mark. I'll be the first to tell you, I don't know that, and I'm not sure a whole lot of people know that. Truly what's going on in China in terms of that. They've always been a fairly major soybean importer. Always have. That's not new. It was even larger this past year. The corn dynamic is different. That's different. So that's the kind of the wild card as we see going forward. We don't really know if we'll look at a chart 2 or 3 years from now and see that even going higher, or if it goes way back down. So that's the wild card. That'll be your volatility. I can't answer that question. Yeah. Thank you. See, stump the banker. Keep asking me questions till he doesn't know.
So given what you talked about the agricultural economy, so if the beginning farmer wants to and wants to enter the market, given the high land prices, where do you see the opportunity? Livestock, or how can they get started?
Yeah, so, again, you've asked the question we've been asking for, 50 years? How do young people get a better start in agriculture? The answer is usually, I call it diversified income. In other words, if you want to be 22 and be a full-time farmer, that may be unrealistic. So you're going to have off-farm income, and then you're going to have to start like many others started. I rented some hay ground. I bought one hog barn, and I've got a contract, so I can leverage that up pretty good, and I can start building equity in an asset. Maybe I can purchase or rent family ground. I can maybe buy a semi and do some hauling. I can start getting some different revenue flows as a young producer. But it's not easy. And especially as our assets have really gone up, that makes the barriers for entry harder. That's just a common sense economic reality. So we have seen them do all sorts of different agricultural, I'll call it related, whether it's manure hauling, custom farming, hay ground, bought a semi, I mean, it goes thing after thing after thing. Start building a cash flow and an asset base, and then when they finally buy that first piece of land, it's usually a small chunk, right? It's not a big chunk, it's usually a small chunk. And there are programs out there that help them leverage, but again, you still have to remember, they still have to make the payment. So just because I'll loan you most of the money, the answer still is, what's the payment? Can I actually make that as a young producer? So I wish somebody could figure out how to make young farmer entry into agriculture easy, because we would solve the biggest, question of the last 50 years.
More of a comment than a question, but yeah, one of your slides was 2022, where we're going, and input costs, and how are we going to weather that? We have very good crop prices currently.
Yep.
We know where we're at. You should have your dry fertilizer down.
Right.
Should have your 32 bought at $700 a ton, or hopefully less. And your seed costs, we were up 10% last year in general, pioneer and stuff like that. But my big question mark is 2023. I mean, can we survive this narrow profit margin in 2022 and carry it to 2023? Because we don't, are these things going to start to reconcile, these nitrogen costs and fertility costs and land costs and everything? That's my big question.
Yeah, and I think your big question mark is always the cycle of agriculture. That is, if we start seeing our supplies start to increase, because, one of the truths that we always know is what's the cure for high prices? High prices, because we start to overproduce. And so, that's why agriculture has always been somewhat cyclical, And so, your question is really, how do we navigate narrower margins, lower prices? It's all about your cost structure. We've got to really be careful during these good times that I don't just start thinking I can afford anything. And what is really your break-evens? And how do you, and what we saw last time when we got to the peak of that market and we started going down, the people who did the best, again, right here, they were extremely proactive about their costs. They got ahead of it. They started thinking, all right, how am I going to cut $50 an acre? How am I going to cut? What are the answers to that, rather than everything else? So I think it's the pace of change and cost structure cutting if we start getting to a tough cycle. That's what we saw last time, and that's probably what it's going to take.
Yeah, we're fortunate. I mean, like, you can try. I've been doing HTAs on 23 crop already now. We're sitting at 20 December futures on it.
Yeah.
23, and damn good numbers.
Yeah.
But we don't know where it is.
Right. So you're locking in some revenue without knowing where your expenses are, but that's a whole lot better. Again, I always tell people in agriculture, our marketing goal is to what? Average up. So that's kind of what you've done. You've put your floor in, right? And if you see more and more price opportunity, I'm going to guess you're going to sell into that rather than I'm going to wait because I'm sure that thing's going higher, and then when it's gone down by 30%, then I start averaging down. And so again, this is what people are doing who have increased their business acumen, is they realize my goal in agricultural marketing is to average up, not average down, but that's harder to do psychologically.
I was going to make one more comment. This gentleman over here was talking about where we're at with land costs, and I was in this, I think it was the same room as the one across the hall about a month ago with Machinery Pete talking about machinery prices. And he made the comment that basically when you're selling your machinery right now, you have to replace it. It's basically bragging rights because the machinery on replacement is just over inflated.
Right.
Machinery. So if you're selling land to replace it, you're just bragging rights.
Right. You're buying back into the same economic environment that you just, like you say, I got a darn good price for that used piece of machinery. Man, do you know what I have to pay for that new piece of machinery? It's like, I just kind of offset everything. So you're right. Yep. We're in the same economic environment. I know we got to get to the next one, so feel free to get up and go here. We're kind of past time. Thank you.